feel like an exclusive club. It's a world filled with complex jargon, powerful computers, and high financial barriers to entry. Many people hear terms like blockchain or mining and feel immediately excluded. But one project set out to change all of that. PI Network emerged with a simple yet revolutionary promise: cryptocurrency for everyone. It was designed to be mined on a smartphone using minimal battery and data. This meant anyone, anywhere, with just a basic mobile device could participate. The idea was to create a truly decentralized digital currency, powered not by massive server farms, but by everyday people. This vision captured the imagination of millions around the globe. To understand the current turmoil, you first need to understand who is at the helm of this massive project. The PI Network is led by a group known as the Core Team. This is not some anonymous, shadowy entity. They have been the public face of the project from its inception. The team is spearheaded by two Stanford PhDs, Dr. Nicholas Kakalas and Dr. Cheng Diao Fan. Dr. Kakalas specializes in computer science and blockchain technology, while Dr. Fan is an expert in computational anthropology. Their academic credentials lent significant credibility to the project. After years of waiting, the community was eagerly anticipating news about the open mainnet launch. This is the moment everyone had been waiting for. The point where the PI they had been accumulating on their phones could finally be traded, sold. Oregon used to buy goods and services. The Core Team had laid out specific conditions for this launch, creating a clear set of expectations. These conditions included reaching certain milestones in user verification, Oregon KYC, migration of PI to the mainnet blockchain. Then came the announcement that changed everything. In a sudden and unexpected update, the Core Team introduced a new 4-year vesting schedule for a significant portion of the pioneers' mined PI. Instead, their balance would be locked, releasing gradually in small increments over a period of 4 years. The reaction to the Core Team's decision was immediate and explosive. The official PI Network chat rooms, social media channels, and online forums, which were once filled with optimistic speculation and mutual encouragement, erupted in a firestorm of anger, confusion, and betrayal. The term 4-year lockup became a rallying cry for disillusioned pioneers. Many felt they had been deceived. They had upheld their end of the bargain. On one side of the divide are the vehement critics. Their arguments are rooted in a deep sense of injustice. They argue that this move is a necessary strategic measure to protect the long-term health and stability of the PI ecosystem. To truly grasp the emotional impact of this policy change, for many, this was more than just a hobby. Take the example of a user from the Philippines who posted a heartfelt message in a community Facebook group. He wrote, "I have been mining for 3 years. I don't have a lot of money. My daughter cannot wait 4 years. I feel like a fool." Pioneers were the project's unpaid marketers, its most fervent evangelists. They defended PI against accusations of being a scam, reassured skeptical friends, and invested their social capital in the network's success. A user from Nigeria expressed this frustration vividly, saying, "We did the work for them. We built this network of millions." Critics also point to the lack of transparency that preceded the announcement. There were no community polls. While the backlash has been, really severe, they argue that the controversial 4-year vesting schedule isn't meant as a punishment. Their main argument centers on preventing a catastrophic price collapse when things finally launch. Imagine for a moment a scenario where over 55 million users suddenly gain the ability to sell trillions of PI coins on the open market. The supply would instantly overwhelm any possible demand, causing the price to, just plummet to fractions of a cent. So, the Core Team's position is that a gradual release of coins by slowly introducing liquidity into the market over 4 years, they aim to create price stability. They compare the PI network to a startup company going public. Early employees and investors in a startup often have their shares locked up for a period after an IPO. Regardless of the economic justifications, the core of the problem really comes down to one simple, powerful word: trust. The relationship between the PI Core Team and its community was built on a foundation of trust that's been carefully cultivated over several years. Pioneers trusted that the team was transparent, but the introduction of the mandatory 4-year lockup for many shattered that trust in an instant. This erosion of faith has some pretty significant consequences. A cryptocurrency's value isn't just derived from its technology or market supply. Now, every future announcement from the Core Team, this uncertainty can be toxic. rebuilding this broken trust to move forward, the core team may need to introduce more democratic mechanisms. The PI network now stands at a critical crossroads, and honestly, its future path is shrouded in uncertainty. The core team's decision has set in motion a series of potential outcomes. If the anger and disillusionment continue to fester, a second major question is whether the core team will stand firm on its decision or yield to community pressure. Finding a compromise might be the most logical path forward. The timeline for the Open Mainnet launch is now more critical than ever. A swift and successful launch of the Open Mainnet could serve to quell some of the discontent. Ultimately, the future of PI depends on whether it can transition from a project based on faith to an economy based on function. Can the core team successfully build a robust ecosystem that gives PI tangible value? The coming months will be crucial. The world will be watching to see if this ambitious experiment in social cryptocurrency can navigate its first major crisis. The story of Pi Network has always been, well, one of grand ambition. It set out to democratize cryptocurrency. For years, it succeeded in building a global movement united by this powerful vision. Millions of pioneers invested their time and, more importantly, their trust in the promise of a future where their daily taps would translate into real value. But the recent decision by the core team, it was a move justified by its creators as a necessary measure for long-term economic stability. However, for a significant portion of the community, it felt like a profound betrayal. This controversy has exposed the central paradox of the PI network, a project that espouses the values of decentralization. The path forward is fraught with challenges. Their next steps, whether they stand firm, compromise, offer more democratic governance for those watching, both inside and outside the PI community. This is a pivotal moment. The future of Pi Network hangs in the balance, caught between the promise of a decentralized utopia and the harsh realities of centralized control. The world's largest social cryptocurrency experiment has entered its most turbulent and defining chapter.